Good Saturday morning, everybody. We're going to cover some important market-moving charts today. We're going to get into about 10 different areas, so I'm going to go through this pretty quickly. What you want to do is simply scroll down the page with me. I've got each section marked by numbers, and I'll try to point out everything that's important on these charts because we've got a lot of important things happening here. Also, just FYI, beginning this week, I believe on Tuesday, you might be hearing me on your local radio station. We're going to be rolling out this Tuesday on USA Radio with in about 480 different markets, a number of vertical research advisory ad campaigns. So listen to that. Whoever still listens to radio, if you still do, and I can tell you that from our previous marketing, which is pretty limited, we did have a lot of success with it. So we're going to be using this to build the VRA. And the reason, frankly, I'm doing it right now is that I believe people are going to be able to make a lot of money in the markets here in the near term. I want to have as many people as possible profiting from the VRA system and for the moves that are coming. Certainly everyone here, as we go through some of these charts, like as we cover what's happening in precious metals and miners, we've had a pretty brutal 5-year downtrend line. It's time to make some money in these stocks. It's time to make a lot of money in these stocks. So it's time to take Mr. Market down, as I like to say. So listen for that this week. Of course, right now, what's happening in the market is Q2 earnings, second quarter earnings. And folks, there's no other way to put it. Q2 earnings so far are absolutely killing it. Corporate earnings are back. We had if you remember, and I wrote about this often, we had a period of more than 3 years where we had an earnings recession. And not an actual recession, but an earnings recession. Take a look at this first chart in front of you, and you can see what's happened here from the election to now. You can see S&P quarterly earnings, that's quoted in billions, just hit an all-time high. That's an all-time high of $317 billion. What is it? More than $4 trillion created in wealth since the election. Animal spirits are back. There really can be no question about this. And as we get into, and by the way, that earnings growth is off the charts. Earnings growth is coming in for the quarter at better than 10%. It was 11% in the first quarter. Revenues are up more than 5%. They were up 6.5% in the first quarter. And we're about halfway through. About half of all S&P 500 companies have reported so far. So, but so far, so good. And I see nothing that indicates this is going to slow down. Animal spirits are back. Essentially, the shackles have been removed from corporate America. And this is the same thing that's happening all over the globe. We're seeing it in the charts. We're seeing it in new all-time highs pretty much everywhere you look, except Russia. Russia is the only market, the only stock market globally that is down on the year. Think about that. Russia is the only stock market that's down on the year. U.S. markets are charging higher and will continue to do so. And look, this gets back to one of the basic principles. I write about it, talk about it all the time. Don't fight the tape. Don't fight the Fed. The tape is the action of the markets, the trends. We know which way they're going, higher. What's the Fed doing? Sure, they're raising rates gradually, but rates are still so unbelievably low. They'd have to raise rates probably for a year aggressively before we'd even be in a position where you start to say, okay, now stocks have some competition from bonds. And that's what's really happening here. And this is where the Fed has been, you have to say it, they have been successful. Their objective was to drop rates to so low that everybody, including retirees, which probably have no business being in the stock market, but are forced to be because they want to be able to hopefully not outlive their money. But investors are forced to put money into risk assets. That was the Fed's objective. They've never denied that. Well, you have to say they've been successful. Of course, they've also been very active themselves in equities. While the Fed will never probably admit that they're buying stocks, we all know that they do. Call it the invisible hand, call it the plunge protection team, call it whatever you want to. They're doing it. There is no question about that in my mind. we know because it's been stated as fact from the Bank of Japan and from the People's Bank of China, the PBOC, their central bank, that they are buying stocks. We know that the Central Bank of Sweden is buying stocks aggressively. I think they're the largest holder, or they hold more Facebook, as an example, than Mark Zuckerberg does. So that's the Swedish National Bank. And so why you can't fight this. You may not like it. You may hate that the stocks are trading at all-time highs and with a price-to-earnings multiple that's higher than it should be. Stocks may be overvalued here, but with rates this low and with central banks buying hand over fist, again, there'll be a time to be bearish. This is not that time. I'm continuing to be amazed by people that are bearish. Now, we always have to keep an eye open because obviously the risks are there. There can be a black swan event at any time. It's probably why it's smart to own some protection for your portfolio, which can mean one of two things. Either have a little more cash than normal or even own some puts as protection. That's basically some insurance. Because the markets are overbought. We've talked about this now in the last week or so in the VRA. We are at extreme overbought levels, but that's worked off some this week as well. So let's go through these charts and take a closer look. The first chart we're going to look at here is the S&P 500, largest stock index in the world. And again, with GDP growth this week being announced of 2.6%, very strong. It was as expected, but still it's strong. We had a weak first quarter, so we're still not at a trending over a 2% growth for the year, but we're gonna be there. Unless something really unforeseen happens. United States gross domestic product is going to top 2% this year. It's probably going to top 2.5% this year. To put that in perspective, our previous president in his 8 years did not have a single year of 2% GDP growth. So this is significant. If you remember what Trump said, he's going to get us back to 4 to 5% GDP. He's had a lot of doubters. I'm not one of them. I'm not one of them. Say what you will about the man, but he is dedicated as an American. He's a dedicated nationalist, proudly so, and he's a damn good businessman. So my money continues to be on him succeeding with what Bill Clinton got long ago, which is it's the economy, stupid. Nothing else really matters outside of national security and that kind of thing. People having jobs, people having money in their bank accounts, being confident that their kids can actually have a better life, or at least as good a life as their parents had. That's animal spirits right there, and it's certainly coming back. So, as you can see in this chart of the S&P 500, since the election in November, the S&P is up almost 18%. That's an historic rally over a very short period of time. Also, and this is important, it's something to watch, if we pull back, and we're nowhere near this, of course, but if we were to pull back to the 100-day moving average, that's the green line you see, the green moving average line, that line has served as solid support since the election. We've gone under it just a couple of times, minimally, but if you want to keep a little extra cash because of the level of overbought we are, look for a pullback to that 100-day moving average and use that to increase your 401k allocations, that kind of thing. But again, no reason to be bearish at all right now. We are short-term overbought. If you look at the screen, you'll see that on stochastics, which is a pretty good measure of where the markets are short-term as to whether or not we're overbought or oversold. Right now, stochastics are reading at about 90% overbought, so that's at that extreme overbought level. But look at everything else, like RSI, which is relative strength, reading right now 62.9. It's just in a solid uptrend. It's not even over extreme overbought right now. We still have a buy signal on the MACD, and money flows. So again, look at since the election. You can also chart this too. That last bar, MFI, is money flow index, And since the election, all that's done is follow this rising trend line. And so everything about this says this market's going higher. There are no warning signs in this. There is no reason to be gravely concerned of some kind of a big pullback at this point. There just isn't, and it should be bought should we have one. Next up. Now, when you say a market's overbought and you're looking and trying to analyze what the risk could be, well, I believe instead of being a risk, I think this next chart, which is of the transports, actually tells us we could have a buying opportunity coming up. And so this is something that the VRA system is flagging right now. Take a look at this chart because I think it's really interesting analysis. And this past week, the transports have been absolutely demolished. We have a 1 week decline in the transports of about 6.4%. That's a big 1 week decline, or maybe just over 1 week. And but it's now pulled back to its 100-day moving average. And this is why I follow the 100-day moving average. It's another important moving average to follow, along with the shorter-term 8-day and 21-day, and the longer-term 50 and 200-day. I also like to follow the 100-day moving average because it's the transports have pulled right back to that level. They've done it on big volume, which is, again, that's a warning sign. But my read on this is that instead of it being a sell signal, if you use the Dow theory, for example, which is something I write about from time to time, I believe this is actually indicating that the transports are reaching extreme overbought sold levels. Look at stochastics. If you just divert your eyes down a little lower, stochastics now are at 97% oversold. So that's extreme oversold levels. I don't have a recommendation at this point. There are no 3-time leveraged ETFs that we can use. I've checked. And there are no transportation stocks. Like I don't typically like to recommend airlines or pipelines or anything like that. A lot of these are MLPs. And the airlines I've never liked, I've never had success with and never used. And these most of the transportation stocks are MLPs, which come with additional tax burdens and things you got to worry about. So I don't have a recommendation here, probably, and probably won't, but that could change. Probably not, but I did want to point it out this morning because a lot of people are talking about the transports. This is a short-term red flag. That there could be a problem with growth in the economy. I don't think so. I think we'll look back and say this is a blip, and it was right back to its long-term trend line, which is a bullish trend line going back again to the election of last year. Okay, let's get to the good stuff now. Number 3, this is gold. It's time for gold to break this 6-year bearish trend line. This is a tweet. You'll recognize the chart from last week. And this is a tweet that I sent out yesterday. But this is the chart that matters most for gold in the big picture. Gold needs to break the 6-year bearish trend line, and then the floodgates will open on the buy side. I believe it's coming. I also believe inflation is coming, as you know. But everything about this chart, this is that 15-year chart that we focused on from time to time. That first circle to the left is, of course, when I went first recommended precious metals and mining stocks back in 2003, gold and silver at that point. Made a lot of money over the years, and I believe that we're about to make a lot more money. But this last 5 years has been brutal because every time we've gotten the rally back to that trend line, which you can see started in the end of the bull market in 2011, every time gold has had a rally, it's failed at this trend line. This is most important. The trend line now hits at about $1,300 an ounce for gold. And I'll just spend a second on this because I think it's important. I focus a lot on the charts as a technician, but it's not. It doesn't make up the majority of the VRA system. I'm still primarily a fundamental analyst. That's why I didn't remove these stocks from the buy list, and that was a mistake in hindsight, obviously. But the VRA system is about 60% fundamental analysis, 40% technical analysis. And the charts do tell us, though, what's coming. And you can see once gold broke down from its 200-day moving average, it's been a challenge ever since from 2011 on. And now the 6-year bearish trend line has served as resistance. And we must see a break of $1,300 an ounce. I will tell you this also, if it fails again, if gold rallies up to $1,300 an ounce or so, then I believe that's about to happen, and it fails, everyone's going to be watching it. Everyone is watching it, and that would be a bearish event short term. Here's why I don't think that's going to happen, and this gets back to the fundamental story of the VRA system and what I learned as fundamental analysis from my mentors. Historically speaking, gold is the original currency. We've covered this ad nauseum. But also historically speaking, you've never had a time in history, ever had a time in history, where you've had insane levels of central bank fiat currency printing, as we've seen, from not just the Federal Reserve, but central banks all over the world. Debt issuance, right? I know I'm a broken record on this, but this is all building to inflation. It has to. As much as the manipulators don't want to see it happen, it simply has to happen at some point. There's never been a fiat currency in the history of fiat currencies that has stood the test of time. Look what's happening right now in Venezuela. You don't hear a lot out of Bernie Sanders anymore on Venezuela, or Michael Moore. Michael Moore was a huge proponent of Chavez in Venezuela, and him giving back to the people and taking properties from international oil and gas companies and doing it all for the people, because that's how great a socialist country is. That was Michael Moore's tweets from many years ago, and now he's very interesting. He's gotten quiet on that. I wonder why that is. Venezuela, if you saw this week, their inflation levels now are at over 800% a year. Inflation. Who gets hurt the worst from that, right? The average person, poor people. This country is imploding right in front of our eyes. It's just to the south of us, but you never hear it talked about in the mainstream media. When have you seen anything in the news on this, right? And it's just a sad commentary on where mainstream media is today. It's why they're losing so many viewers and followers, because they cannot be trusted. Of course, this is a big part of what got Trump elected in the first place. People are waking up. Social media has played a big role in that. But at the heart of the matter, gold has to move higher because of global currency inflation. Look at this chart in front of you. If you look at the volume, I've got a big circle around the volume. You can see that from the financial crisis on, look at the increase that we've seen in volumes in gold. And it's steadily grown, even as gold has declined in price from the 2011 highs of about $1,900 an ounce. Volumes have continued to build. Why is that? How can volumes build when the price is declining? Well, it's manipulation. I won't get into all of it today. I've written about it a lot over the years. I might write something this week on it. But if you want some great research on it, I encourage you to go to GATA, which GATA.org, I believe it is, GATA.org, which stands for Gold Antitrust Action Committee. I first met these guys, 15, 20 years ago at least, and there's no one that's done the level of work, due diligence, lawsuits that they've done, where they've exposed exactly the manipulation that's happening in precious metals. It's happening for obvious reasons. The powers that be do not want gold to go higher because that tells everybody something's wrong. Well, we have a new sheriff in town right now, and his name is Donald Trump. And he's a big believer in gold. All you have to do is remember the pictures of Trump Tower, and also, as we covered around the election last year, he's put a lot of people into power in his Treasury Department that are big advocates of gold and even returning to the gold standard. That's what Trump has personally talked about before. He's also talked about auditing the Fed, because that's where the manipulation is coming from. And their most powerful banks of choice, like J.P. Morgan. And he also, and this is really not being talked about much, but in the very near future, Trump is going to be adding three people to the Federal Reserve, three governors to the Federal Reserve. I think it's three, maybe four. And this is being watched very closely, but of course, we also know that other countries like China, Russia have been buying gold aggressively. Central banks have. Of course, there's the new Middle East Sharia-compliant gold exchange that's opened. So you're getting buying from a lot of places, and the ability to manipulate and control the price through just one exchange is disappearing. So I think for all these reasons, gold is about to blast through that bearish trend line. Again, it has to happen for us to stay bullish. And if we scroll down, let's now take a look at the next chart of silver. Silver still has some work to do. Silver is still below, even though it's had a nice sharp run up here. It's still below both its 100 and 200-day moving average. It just closed just barely above its 50-day moving average on Friday. And this next move higher, should it happen, I believe it will take silver out of this big bearish channel that you see right in front of you. These channels are great trading tools. And as you can see, if you would simply sold silver at the top of each move in the channel and shorted it, you could see the kind of money you could make. It's been very dependable. However, if you look at this big circle I put in volume, we saw a flash crash in silver, a one-day flash crash, and that very likely could be a selling climax that happened in silver, because even during the declines, look at the RSI. Relative strengths continued to increase. Look at money flows. Again, even as the price has declined, money flows are returning to silver. These are contrary indicators to each other, and I believe most significant. Now, silver is reaching short-term overbought. It's about to 90% overbought. That's extreme levels. But frankly, I don't think it'll matter much. I think that with the level of growth we have, the return of the reflation trade, the fact that global economies are absolutely improving, folks, you have to have inflation with that. You can't have economic recovery on the scale we're seeing now with corporate earnings growth the way that it is. And the move higher we've seen, for example, in copper, we've been covering that here. All of these things dictate that inflation must be rising. So very bullish on silver as well. But silver needs to break out of that bearish channel, and it needs to get back above those most important moving averages. Next up, now we get to the meat of the matter, things that directly affect some of our core holdings here with the VRA. GDX, the chart you see in front of you, GDX is the miner ETF. Talk about it all the time. It's very important, or bigly important, for our four recommendations in this space: Vista Gold, VGG, Turquoise Mining, TRQ, and then the two leveraged ETFs, NUGT and JNUG. NUGT is the large cap 3-time leveraged ETF for miners, and JNUG is the small cap 3-time leveraged ETF miners. Again, these are very volatile, but also give you the most explosive upside potential. I believe they must be owned now. Look at the chart of GDX. GDX is the underlying ETF for the leveraged ETF. So they use derivatives to increase their gains, but it's all based on, most of it's based on GDX as the underlying ETF. That's why we focus on it. Big week. It was a big, important week for GDX. We are now officially in bullish confirmed status, according to the VRA system. We're above every moving average. Full on bullish. Next up, we need a convincing break of $23 a share. You see that downward trend line connecting the tops there, going back from about mid-February of this year on. Well, every time, again, just like the silver chart above, every time we've challenged this level, GDX has been pushed back. We need to see a break of this. Once we can see a break now, and I believe it's going to happen because we're back above the moving averages. Everything else that you see, from RSI to money flows, MACD, everything is giving a buy signal. Nothing is overbought yet. And a break of this $23 level in GDX will be a confirmation break. And that would send, at minimum, would send GDX up to about the $26 level, $25.75 in that range. And then a new bull market's born. I think it is now. A lot of people are waiting for that breakout move in gold to confirm at $1,300 an ounce before they fully commit. And we need to see volume in GDX. We're getting it a little bit more on the buy side, but still nowhere near where we want to see it. I want to see 100 million shares traded, buy-side volume, big up days. I want to see 100 million shares traded back-to-back days before I can confidently say it's blast-off time. I believe we're there, but now we need to see the confirmation of that. Okay, let's go next up. Okay, we'll transition a bit to another VRA holding, which is YINN, the 3-time leveraged China ETF. And what I've done here is show you a 3-year chart. Again, it's a leveraged ETF, so its price discovery is not the best. But what you see here in the early parts of 2015, the circle there, that was the high. And what's interesting here to me is that, again, global markets are trading at all-time highs. China is just now starting to break out again and approach something that you could say is now full-on bull market. It might get back to those highs, but still considerably. Yen is still 60% lower than its 2015 high. So that tells me there's a significant amount of upside potential here. China is back. Yes, they have a ton of debt. Yes, unless they continue to grow, their debt could be a problem. But this is China, folks. If you haven't been to China, when you go, first of all, you'll barely be noticed. The Chinese do not even notice Americans pay any attention to us. We're not well liked there, not well liked, not respected. But their work ethic is pretty amazing, and they're incredibly industrious. We've always been able to beat them because we've been more creative, and that's starting to change. So there come up some really good ideas. But anyway, the point I want to make here is that even with all the debt they have, they're now getting growth back up to about the 7% level, and I believe they'll outgrow their debt issues. So to date, we have about a 16% gain in our position in YINN. But again, still 60% lower than 2015 highs. Yes, it is short-term overbought. We're looking at about 92% overbought, extreme overbought levels. But it likely doesn't matter very much. Again, China's back in full-on growth mode. And unless some unforeseen black swan happens, this must continue to be owned and purchased. It's going a lot higher. You're always tempted to, if you get a 15, 20% gain short term, should we take that gain and wait for a pullback to buy it again? I'm just not going to play that game because I think that we've got a global bull market on our hands, as I've talked about all the time. Until we get investor sentiment to the point of extreme levels, investor euphoria, and we're just nowhere near that. I'm not going to try to take short-term profits on these. We're going to let these profits run. What you want to do instead, again, is dollar cost average into these as you can. Build your position size as you can. That's how the smart money does it. That's how we do it. All right, next up, and this is a short-term issue for us because Cara Therapeutics has been very disappointing. But again, this is the chart, but it has very little to do with the reason we own the stock. We own Cara Therapeutics because of the fundamental side of the story, which is even though the FDA results were semi-disappointing, this company has so much more to offer, and most of the people and the analysts that I've listened to and the management that I've spoken to believe that these FDA results were widely misinterpreted. The shorts certainly don't think so. But anyway, let's look at the chart. We are now back to the 200-day moving average. So technically, this level around 14 needs to hold, which is where it closed on Friday again. The 200-day moving average has served as support in the past. I fully expect it to do the same thing. This week, they're going to announce earnings. I think it's on Thursday of this week. They'll have earnings. That's not really that big of a deal. This is not a company that even has cash flow, but it will be interesting to track their burn rate and see what kind of cash they're burning through, which will tell you whether or not they got to issue more shares to keep funding the company. But as I understand it, the company is fully funded through 2019, so I don't really have any concerns there. Short interest now is at 9 million shares. It's down from 9.8 million shares, but Still, at 9 million shares, that's a very big short interest. And it pretty much equals the number of shares that are in the free market when you remove institutional holders and insiders. So it's about a 1-to-1 ratio. That means good news, and Kara is gonna bring a major short squeeze with it, which is what I expect. That's all we really can see in this chart. As you scroll down a little further, you'll see the latest short interest report as of July 14th, which has short interest at just over 9 million shares. Next up, chart number 8 here is Falcon Oil and Gas. This is the U.S. symbol, FOLGF, since most of us are in the U.S. and hold it here. As you can see, Falcon continues to use that 28-cent level, and this has been the case since May. The 28-cent level has served as support. It's had 1 or 2 blips beneath it, but those were short-term. And then right back up, closed at just under 30 cents on Friday. And there's not a whole lot you can see in this chart, except that volumes have really dried up, which is to be expected. Everybody now is waiting on one thing, and one thing only, and that's the October draft report from the Northern Territory. I don't really see the downside story here. I don't understand people that would be negative on this or think that the scientific inquiry was going to be a negative. So much pressure has been brought to bear on local Australian governments that all that they're going to do is continue to lose federal funding, what they call the GST, with any of these continuation of any of these very silly drilling and fracking restrictions. So what we want to do here, folks, is, in my view, is pretty simple. Continue to dollar cost average. I know it must sound boring, especially to those of us that have owned the stock for a long time, but hey, we've got sunlight now. We have daylight. We are moving in the right direction, and we've waited this long for goodness sakes. We can wait about 3-4 more months to get that October draft report from the Northern Territory, which will send this stock sharply higher. Again, my target, my year-end target is minimum 75 cents a share. So it's what is that? 130% higher from here, and that's on the low side. But next year is when fireworks should really start. That's when we get over the dollar level, and by then you're going to see investors from all over the place buying Falcon Oil and Gas because, again, they've got a world-class times what? 10, 20, 30, 40, 50 natural gas field in the Beetaloo Basin, and that's going to bring a lot of interest. And quite hopefully we'll get some good news out of South Africa as well, because they're big 7.5 million acre position there with their partner Chevron. At some point we'll hopefully come back to life if anyone can wake up the South African government with their own silly restrictions on these kind of things. So again, continue to buy Falcon Oil and Gas, my stock of the century, and it ties into our next chart, oil. Okay, oil did something very interesting this week. Now, it may be a little premature, but oil has now broken out of, just barely, but it's broken out of its bearish downtrend channel. As you can see there, it closed at $49.71 a barrel. And I just wanted to focus on this briefly this morning because there's still so many bears on oil. I'm not one of them anymore. I was bearish on oil at over 100. I became bullish on oil once it hit in the 20s and broke back above the 30s. And I've been positive ever since. There have been some decent trades you could pull here of both sides, but I think those are only short-term trades. The big picture here is that the lows are in place for oil, and that global demand is really picking up, and supply had this huge overhang of supply. It's really been eaten into, as we've seen after week after week after week of the EIA reserve estimates have really fallen off. So I think 10 out of the last 12 have seen negative numbers. That's what had to happen for oil to get bullish, and I think that's what's happening right now. I will say, look, if you look at the chart, the technicals here, stochastics now at extreme overbought levels. No question about it. At the top of the channel, smart play might be to be short oil here in the short term. It might be. But it obviously doesn't matter to anything else. We own Petrobras, of course, PBR. But again, I think any pullback from this point is going to be a minor pullback. We're seeing really good buy-side volumes come in. And I think more than anything, we're going to see a continued move higher in oil, probably get us back to the $60 to $70 range much sooner than later. So short-term overbought. Still got to eventually get past that $52, $53, $54 levels. A lot of selling pressure waiting there. And then it's off to the races again. But I pointed out the oil chart to point out this last chart I wanted to show you today, because this likely will be our next buying opportunity. If you follow me on Twitter, you see I've been talking about this. I've written about it in the VRA a number of times as well, because what I see in the oil services ETF chart, that's OIH, is a chart that looks almost identical to the charts that I focused on last year with the biotechs. The biotechs had been in this terrible bear channel, and then when it broke out of that in early 2016, it's been off the races ever since. I see almost the exact same chart with oil service stocks, and if you think about it from a common sense point of view, it makes a lot of sense. These shell companies are making money hand over fist, even with oil at 40, what is it now? What is 40, 49 or 50, close to 50? They're making money at $30, $35, $40 a barrel. So they're drilling, and the rig count's increasing. Who's that bullish for? That's bullish for oil service stocks, and that's happening globally. So I believe with this group so heavily oversold that we're seeing right now a rotation back into oil services. So it almost doesn't matter very much in the short term what oil does. This group, I believe, must be bought. The bear channel has been broken. We've seen a pullback now out of that breakout. Everything about this says we're looking at not just an advance, but a multi-year bull market in oil service stocks. And I will tell you right now, there are no leveraged ETFs for this. I wish there were. There aren't. There are leveraged ETFs for energy and energy stocks, but not for oil service stocks. This is the sector I want you in. One of the companies that I helped raise money for was a company called Patterson Drilling. The symbol's PTEN, Paul, Tom, Eddie, Nancy. I didn't include a chart here, but I'll write about it this week. This could be our next buy recommendation. The stock closed at, I believe, just around $20 a share, considerably cheaper than it was a couple of years ago. They're one of the major players in the oil services business. I used to follow this group very, very, very closely. Made a lot of money in this group over the years, and so I'm getting antsy here to get us back in this. And I'm doing the analysis, trying to find the right group. But just put this one away. Remember this group, and just think biotechs. Think biotechs from early 2016, because all they've done is go straight higher from then. I believe we're gonna be in this group in the very near future. It'll probably be our next buy recommendation, folks. With that, thank you for listening this morning. Hope you have a great rest of your weekend. I'll see you back again first thing Monday morning. Bye bye.